Yes, then I will say good morning to all. It's now 9:30 here in Denmark, Danish time. I'm Torben Johansen from FSR Danish Auditors, and I'm welcoming you all to this web meeting where we are going to have a discussion on the exposure draft, on general presentation and disclosures, and also a welcome to the members from IASB and EFRAG. That is, they are joining us here today to have this discussion on the disclosures. And we think it is very important to have this kind of a meeting and to discuss this general presentation and disclosure exposure draft, because we think it will be something that will have a significant impact on presentation and disclosures for many companies. And that's why we think it's a very good idea to have this kind of discussions. And we have set up some topics for this meeting, for the agenda that we would like to go through and to have a discussion on. And hopefully you will all send some questions to have a good debate, discussion on these topics, so we can all have something for this meeting. The facilitators for the meeting is Jan Peter Larsen from FSR and Kristian Koktvedgaard from Danish Industry. So I will give the word over to you, Kristian, for the presentation of the agenda.
Thank you, Torben, and also a warm welcome here from my side, from the Confederation of Danish Industries. I think we're very fortunate and honored that we can do this outreach today with both EFRAG and the IASB. Unfortunately, we just had information this morning that Francois Flores is not able to join us, which is unfortunate, but we have confidence in the fact that we have another good presenter as well from the IASB, namely Aida. And you have to understand, for those of you who doesn't know me, I'm awful at names, but I'll try my best anyhow. Also a warm welcome to Chiara Prete from EFRAG Tech Chairwoman. I think we have a few very good speakers lined up there. What is not in the program is the fact that we have also made an alliance with a few selected preparers. They will be speaking in a personal capacity, but they will be allowed, they have been invited in order to stimulate the debate. During the meeting, we would highly recommend you to ask questions and participate in the polls using Slido. And I think we have already one Slido poll open. If we could have done one, namely the introduction slide polls with the professional background. And we'll use that as a test to see also whether you are participating and also allowing the audience to see what is actually the broad representation here today. Usually we run the meetings in a national context when it's physical meetings, but I think we are also very honored today to have a very broad international audience. I think we have a good broad selection in participants, both from preparer, community, academic, and also user background. So I think that's very fortunate. I can see currently that we have 26 participants currently using the Slido. Probably a few more is going to join. I know that around more than 100 is signed up. Probably some of you will then download it afterwards. So I'll please encourage you all to use Slido, the Q&As. Jan Peter and I will try to ensure that we ask the questions at the appropriate times. We'll try to steer the debate through the topics. I have to say the timing of the topics is not cast in stone. The end time at 12 o'clock is cast in stone. We will definitely finish by 12, but we may choose to spend a little bit more time on one topic or gradually advance to the next topics as we go. I think those were the initial practical comments from my side. So with this, I think we are ready to start the actual presentation and the introduction of the IASB exposure draft. And I would like now to give the floor to the IASB. And I understand that Aida will try to talk us through the slides. And please bear in mind that Francois was supposed to make the presentation, and Aida has kindly stepped in with short notice and is going to take us through the presentation. So Aida, a warm welcome, and the floor is yours.
Thank you very much, Kristian, and good morning, everyone. It's good to hear you. I hope to hear many of you or hear your questions in this session. My name is Aida Vatrenjak, and I'm IASB technical staff, and I'm a project lead for Primary Financial Statements project. And as Kristian said, initial plan was that I would share the presentation with Francois, and Francois was going to do these introductory remarks. So I am going to do them now. So I believe you can see the slides with presentation there, and we have a few slides that are showing us the objective of the project. And the project timeline. So what the Primary Financial Statements project is it's a part of IASB's work on better communications and financial reporting, which is the initiative that arose of our last agenda consultation, which has happened in 2015, where we had overwhelming feedback that one of the priorities for the board should be improving performance reporting and generally improving how information is to be communicated in the financial statements. And this is where the work on this project really got reinvigorated, because you might recall that about 10 years ago that there was an effort, a similar project in past, but quite different in the scope. And why is it different in scope to what we have done then? The reason is that since that 2015 agenda consultation, to help us inform what are the priorities for work on performance reporting, we have done lots of user outreach, and in that outreach, we have asked the questions on what are the areas where users want to see most improvements in the financial statements. And I think maybe if I can just jump to the slide that talks about the key project areas, and this gives us the messages we have heard. And the key messages there were that the key problem that users found with statements today, that there is not enough structure and the comparability in the statement of financial performance, that therefore makes it very difficult for them to compare performance between companies. And this is what has really driven the board to one of the key, I would say, proposals in the project, which is to propose new defined subtotals that would improve this structure and comparability and provide additional relevant information. And another thing that informed the board was a range of feedback received around disaggregation of the financial statements or information included in the financial statements. The users have told us that often the way information is grouped or ungrouped doesn't give them information they need for their analysis. And often here we heard example of, say, items described as other, that users tell us sometimes can account for a large proportion of a note disclosure, but without further explanation. And then this makes them wonder, is there something here we should be worrying about? Why is there no information about that? And in response to this, the board has proposed a range of both general and specific proposals with aim to improve disaggregation in the financial statements. And then the final theme of this project is the feedback we have heard around the alternative performance measures or non-GAAP measures, which is that users have told us that they find information included in these measures useful. It can be relevant to their analysis, but they often struggle with finding the information they need about these measures, because these measures are generally outside financial statements, and it's not quite clear where they can be found, or information is dispersed in the management discussion, in the management commentary, for example. And also they told us that they sometimes find companies change these measures from period to period without really explaining what has changed and why it has changed. So, and this is what has driven the board to have this third main set of proposals around what we defined as management performance measures, which would improve transparency and discipline of this information by bringing them into a single node that will be included in the financial statements. And then finally, we have some proposals relating to the statement of cash flows, but they are quite targeted, because the feedback in this project, the board has decided not to focus really on the statement of cash flows, and but has left the door open, of course, subject to future feedback in the general consultation, to do more comprehensive work on this statement. And maybe just before I hand over to Chiara for introduction from EFRAG side, just to remind everyone that the comment period for this exposure draft has now been extended due to COVID-19 pandemic until end of September. So we have more time to have consultations and discussions with stakeholders such as this one. And we also have more time to conduct the field work, which is very important in informing the board on how the ED would apply and whether adjustments are needed and what adjustments. And just to note, now I think we have a slide on what actually would happen, what would the final standard look like with this exposure draft. So the idea is that if finalized, the proposals would replace current IAS 1 on presentation of financial statements, although just to note, as you have seen, the scope of the project does not cover everything that is in IAS 1. So this means that some parts of IAS 1 would be moved over to a new standard without much change, or with limited wording changes. And in addition, this exposure draft I mentioned already is proposing some limited amendments to IAS 7, but we also have proposals to a range of other standards that are listed on the slide here. And I think as we go through presentation, I will touch on some of these in more detail. So with that, I think it's time for me to hand over to Chiara.
Thank you, Aida. Good morning to everyone. Thank you to the Danish FSR and DI. I'm pleased to be here in this webinar. As Kristian said, this started is addressed to the Danish stakeholders, but we are pleased to see that this way of interacting with the webinar is attracting also a broad European audience. So it's a pleasure for me. So coming to the IASB proposal on PFS and to EFRAG work and position, this is a very relevant project for the IASB, for the financial reporting community, and as a result also for us. It has been an important investment in terms of the preparatory work that we have done, and as a matter of fact, EFRAG has followed all the development of the IASB project across the long period of preparation of these proposals. We have been cooperating and interacting with the IASB and the IASB staff all along the due process. So we are particularly happy about also the cooperation with the IASB on how we developed our positions. In 2019, to prepare our position, we ran also an early stage analysis with a desktop analysis of the current practices of the European entities to support the expected ex-ante impacts of the proposals, which are described in the notes to constituents attached to our draft comment letter. I will guide you through EFRAG positions in detail topic by topic in the rest of the presentation this morning. However, I have to anticipate to you that on a few relevant topics, our expert group was divided. Therefore, we included some supplementary questions in our consultation, which we can find in our draft comment letter, and I will also introduce these questions during the presentation later on specific topics. Because, of course, the input that we get during the consultation in our draft comment letter will inform the final position that EFRAG will take in this respect. What we have now are our preliminary views, subject to your comments. In terms of position, the comment letter was issued the 24th of February, and it's open for comment until the 28th of September. So we invite you all to let us have your input on the letter. We are having outreaches with different types of stakeholders. This, as a matter of fact, is one important public webinar that we are having. Originally, they were planned to be physical meetings, but they've been converted into online events. We are also preparing, in coordination with the IASB and with the National Standard Setter, the preparers field test. So to test in practice these innovative proposals that are in the IASB exposure draft. The field test will be run by the 31st of August and will focus on the implementation and application concerns of the proposals, including also the costs and effort to implement and apply. So we would welcome any preparer that wants to participate by the 31st of July. We still welcome preparers to participate to this field test. If we go now on the overview, high level of EFRAG position, in general terms, we are very, very supportive of these proposals. We think the result will serve the purpose of better communication of financial information and will mark a modernization of the financial reporting. So we are very, very supportive, and it is for this reason that on some areas we have expressed some reservations in order to get at the end an even better and more practical result. In this slide, I have included some comments on minor points, perhaps, of the consultation, which are not covered in the rest of the presentation. So the position will be illustrated topic by topic when we go there. So you find here some messages on the topics that are not covered in the rest of the presentation later on. We support the separate presentation of integral and non-integral associates and joint venture. We noted from our impact study that there was a divergence in practice of presentation of these components, sometimes before, sometimes after the operating income, the operating profit. So we think this could help in enhancing the comparability. However, it's a new concept. It has to be tested in practice and involves a judgment. So this is one of the areas where in our field test we will ask specific questions because it may have also implications in terms of, for example, governance to put in place these proposals. We also note and regret that the IASB has not defined two important measures, EBIT and EBITDA, which are used very much in practice, and we think they should be included also. They should be included in the scope of the proposals of the management performance measures. Another point where we comment is the other comprehensive income, where the IASB in this project has decided to simply modify some labelling of components in OCI without undertaking a more deep assessment of what is the conceptual difference between items presented in profit or loss or in items presented in OCI. It's true that this has been covered by the conceptual framework, but we still think that there is need to a better understanding. What we see in practice is that analysts never ask a question about OCI or indicators thereof. So there needs to be still something to completely understand, and also the role of recycling. We support the proposals of the IASB on the statement of profit and loss, but we also suggest some improvements for the future on the other financial statements, like, for example, the statement of changes in equity, to allow to represent clearly the difference between ordinary shares and other instruments that can be settled, for example, by issuing ordinary shares, and to include additional implementation guidance. With reference to the statement of financial position, we would have welcomed, for example, a definition of debt, which is currently missing, and it's a key metric used by the users. And also related disclosure. So, as I said, in a nutshell, we are very supportive. These are all suggestions for future path of further development, or recommendations to make the proposals work better in practice. This is all in terms of presentation by my side.
Thank you, both of you, for this initial presentation. As indicated, we would like to have the discussion devoted into the topics we have tried to illustrate in the invitation. And the first topic that we found was relevant was actually to try to address the issues about the defined lines and subtotals in the income statement. Whether this is improved comparability or as we say, imposed uniformity. I will please remember to use the Slido if you want to raise some questions. But I think we'll start now with the first topic. I'll give the floor back to Aida for key topic 1.
Thank you, Kristian. So what I will do is give a brief overview of the proposals, the key proposals on subtotals and categories in the statement of profit or loss. But before I do that, I just want to share some good news. I was able to organize for Nick Anderson, our board member and a lead board advisor on the PFS project, to join us this morning. So I've just shared details with him, and he will probably be joining a call later on, and he will help provide maybe some more insight in the board's thinking when we come to discussing the questions, in particular given his background as a user of financial statements. But with that, I would like to refer you, I think it's a slide 14 in the presentation here, on the proposals for subtotals and categories, and illustration we have here. So what the board is proposing is to require all entities to classify income and expenses that goes into profit or loss into 4 new categories that you see here on the right-hand side of the slide, and to present 3 new defined subtotals that will be mandatory for presentation in their statement of profit or loss. And just to give you a health warning here, so we find that it's easiest to explain the proposals using this illustration, but this is only an illustration. So whilst the subtotals that you see here would be mandatory, many of the line items are just here for an example, and if not minimum line item, then they are just they wouldn't be mandatory to present as a result of the proposals in this project. So with that, let's look at operating category and operating profit or loss subtotal, and this is really key performance measure for many companies. In our research, we found that this is probably most commonly used subtotal there today, to an extent that when we speak to users of financial statements, they get surprised that this is already not defined subtotals, because they see it everywhere and they sometimes assume that there is a common definition, but there isn't one. And in practice, there are great differences into, as expected, into what entities classify or do not classify in this category. So how has the board gone about it? So the objective with the operating profit is to ensure that it captures all income and expenses from entities' main business activities. So its key performance metrics should be captured in there. But this is not how the category has been defined, but rather the board has defined it as a default category. In other words, the board has said all income and expenses that do not meet definition of other categories are by default operating, should be classified in the operating. And there are two kind of a basis for this approach. One is the thinking that by default, everything entity does is operating. They are in the business to run their business. And then the second, the board thought that this kind of residual approach would be better in achieving consistency and having more comparability into what entities classify in the operating profit, and therefore giving better information to users of financial statements. So that was operating. So let's have a look at the financing category right at the bottom. You can see here green. So the objective of this category in the subtotal that you can see, profit before financing and income taxes, is to help users compare performance of companies regardless of whether they're funded by debt, equity, or a mix. And the main item that you can see here, as you probably expect, what we describe here as expenses from financing activities, and this is really your interest on loans for general corporate. So this wouldn't apply to banks and similar entities, but we will come onto that a bit later. And in addition to this interest on loans, there are few other items that the board has proposed to classify in this category that are maybe strictly speaking not meeting definition of financing, but they are classified there because the board's view was that users would most often treat them as a part of the financing. And one of them you can see in the example on the slide, which is unwinding of discounts on pension liabilities and provisions. So this is basically time value of money or interest type of expense on liabilities that are not financial liabilities. And the second item, which you can't see here, is income and expenses from cash and cash equivalents, which would also be here and which would be presented separately if material. And then in the middle, let's look at what is in the investing category. So this is the board has defined income and expenses from investments. And the objective of this is really to enable users to separately analyze returns from assets that arise quite independently from other resources of the entity. So again, this is an example for what we call general corporate. The things that you would see here are returns on your financial instruments, or perhaps some of the rental returns that you get. And then you see something here between operating and investing called integral associate and joint ventures. And what is this? So this is really a result of lots of discussions the board has had once we have these categories to say, what do we do with share of profit or loss from equity accounted associate and joint ventures? So just to highlight, this is only for equity accounted instrument investments. And we had a quite different feedback from users and preparers on this. So users on one hand have told the board that they really don't want to see any share of profit commingled with the operating profit, because that would mess up users' margin analysis, because there is no revenue equivalent in the from equity accounted associates. There's just a single line. So the user said, we want this outside the operating profit. We analyze these returns separately, even if they are related to entities' operations. On the other hand, the companies have told us that they view many or some of their integral associate and joint ventures as quite integral or closely related to their main business activities, and they would like to see them as part of operating profit, or they would like to present them as part of operating profit, which is what some of them do today. Not most of them in our research, but some do this today. So the board has kind of balanced these views and said, okay, to meet users' demand, we are not going to require presentation, or we're not going to permit presentation of share of profit in operating for any company. But to meet the preparers' needs to communicate about these associate and joint ventures that are closely related to their main business activities, we will require companies to identify separately those that are integral and pull them out basically from the investing category, where all the non-integral associate and joint ventures will be classified, and put them separately, as you can see here, this line item, share of profit or loss of integral associate and joint ventures. And this would be straight after operating profit, so that it is close, and then we have this additional subtotal in the middle, operating profit and income and expenses from integral associate and joint ventures, that will be presented as additional subtotal. So this sums up my summary of the proposals for the subtotals and the categories. And maybe just to highlight before handing over to Chiara, that existing requirements for separate presentation of discontinued operations and income taxes are not affected by this project, and therefore they would remain as they are today.
Thank you, Aida. I refer to the slide where it's presented the EFRAG position with reference to topic 1. We absolutely support the proposal to include these subtotals, and in particular also our early stage analysis, consistent with other researchers and with what Aida said. We note that a subtotal of either operating earnings or operating result is used by almost all the entities. So we see really this as a key proposal of this exposure draft, as it will have an impact for almost all the IFRS issuers. Of course, what happens now is that the operating profit is self-defined by the entity. So the preparers will have to understand to what extent what they are today calling operating earning, operating result, will fit into the operating subtotal as defined now by the IASB. That's why it is important to understand what are the concepts behind the different subtotals that the IASB is now introducing. So in practice, we think these, the cutoff, the dividing line between the operating, the investing, and the financing will be critical in terms of test in practice. And there is a component of positive definition in the operating, so it's the entity's main business activity, but at the same time, there is also a component of residual in this definition, because it is operating everything that doesn't fit into the financing nor into the investing. So to see how in practice these two components of residual and positive definition will work, it will be critical. But it is also important because it is the way in which the structure has been provided. So now we have the potential for enhanced comparability, but we have not rigidity because the company will still be able to include all the line items that fit into their specific situation. What is defined now is the subtotal. One remark that we have with reference to the new categories is that also if they are labeled in a similar way of the proposals that the IASB is using for the cash flow statement, some items are not perfectly aligned. So we encourage the IASB, unless they decide to go for an alignment, to use different labels to achieve clarity and understandable results. Another thing that we have seen with the preliminary interaction with our stakeholders in our working group is that in Europe there are already regulatory frameworks, mainly in the banking and insurance sectors, but not only. Some countries also issue detailed structure for the financial statement presentation at local level. So we also highlight that this will be an implication. So the entities will have to see whether the regulators will finally adjust to this new structure and how the two things will go together. I think I may stop here in terms of presentation of EFRAG view for this topic.
Thank you very much. I think we might have a new poll on Slido, and while we get the poll up and running, I'd like to briefly give the floor to Nick Anderson, a board member that has just joined us with a short notice, and we're very happy and fortunate for that. So Nick, I don't know whether you just want to briefly introduce yourself while people can vote, do the polling question.
Yes, of course, and good morning to everyone. It's a very pleasant surprise for me to be able to join you this morning. This is clearly a subject where there's a great deal of interest. As Chiara suggested, this will probably impact virtually all issuers, I think. It's also a subject where users of financial statements have for a number of years been asking for improvements, and I think what we've heard from users so far is that we have a good set of proposals that help get them in that direction. Just briefly, by way of background, I joined the board in 2017, and prior to that, I had just over 30 years working on the buy side as either an equity portfolio manager or managing equity research teams. So these subjects are close to my heart. Thank you.
Thank you very much, Nick. And I can see we already have some answers on our first question here, whether it will improve comparability or not. And I suppose roughly 3/4 of the participants say that it will actually improve comparability, with a quarter roughly saying that it will impose uniformity. So I think it will be interesting to learn from our three preparers that we have here that can also ask questions. We thought that would be good for stimulating the debate. I'll first give the floor to Tina Agerholm from Carlsberg. Tina, the floor is yours.
Good morning, everyone, and thank you, Kristian. And thank you for inviting us to this meeting. It's always good to have these kind of discussions. I think this is a really relevant topic, and it's something we have been asking for the last many years when we have been providing feedback to draft proposals on the recent standards that have been issued. So this debate is really important, and I do believe that we need to do something to improve the way we present the annual reports across companies in Europe. And I think there's a lot of good things in the proposal as we see it now. But I also think there are areas that we should still have a debate on, and where we can probably improve the proposal and the reporting even further. So a few areas where I would be concerned on how this would actually impact the reporting and whether it will be an improvement. The interesting thing about the poll was to see that the majority think that this will improve comparability. It might be hard to say anything but yes, that it will improve, but what is it that we are improving? Because if the improvement is just a common definition of a subtotal, but what we have in that subtotal is completely different by nature with the types of businesses, what is it then that we are actually comparing? Because if it's fruit baskets filled with different kind of fruit, then is it really comparable? And that's probably where I think that this might need a bit more of elaboration in terms of what is it that we have in our businesses today. And when I look at one of the suggestions that we see to separate how we classify the income from associates based on whether they're integrated or not, then why don't we see the same kind of separation of our primary business? Because our primary business might have elements that are not as integrated, to use the same kind of wording, as in our associates, but now we are actually required to do everything that is the core business, whether it's core or semi-core, and show that above operating profit, and with no opportunity to separate what might be secondary, even if secondary is not big enough to be a segment, because then that's of course something different. And those secondary things will often have a different impact year on year. So what I could see as a risk is that we, by these ways of determining what is above and what is below, that we would actually see things being grouped above as if it's all kind of the same, but without being able to, in the P&L itself, show what is the real core business and what is secondary to the operations. And I find it a bit weird that we make that kind of distinguishing in the associates while we are not doing it on the business itself. So why should it be important for associates that are probably the least material to the vast majority of all of the reporting entities, but we are not doing it to the business itself? So that thing would, for me, be one area that we need to discuss further on. Could we have an element still above operating profit that could be secondary, and where we kind of isolate things that might have different fluctuations and not be part of a standard development year on year, to avoid the KPIs that we will calculate on operating profit, or just the measure of operating profit itself, to be impacted by elements where you need to go deep into the explanations in the notes to actually find that, or having to spend a lot of comments on that in the comments that we provide to the P&L when we do the announcements. The other element around that would be looking into what is the nature of businesses today. Businesses today are completely different from what they were 10, 15 years ago. And most businesses operate in matrix organizations. So with that way of operating, why don't we reflect that in the way we present our P&L? Why are we forced to choose between function and nature? Why can't we do a bit of both, depending on how we actually manage our business? By doing that, we could provide information that by line item would be much more relevant in describing the business itself, without taking the information in the subtotals away. And we could still provide additional information working from function to nature or vice versa in the disclosure notes. But it would make a much better picture of what is relevant for the business in terms of its operating model and the way we are actually managing our businesses and the way we want to communicate to the market on how we are managing, how we are operating, and what is then the financial impact on that. The last major item I think is we need to address is the split between what is in operating and what is in investing. A lot of businesses have a very long history, and for that reason, it might have production facilities where they are moving out of, or they are changing their business model. So they're disposing of old production sites with large gains in certain years. Reporting those within the lines as they are defined now in operating profit might disturb the measure of operating profit in the year where you have a gain on disposal on those kind of assets. Why is that in operating? Or should we consider putting that into investing rather than only having the associates in investing? That would also match with what we do in the cash flow statement. So that disposing assets, which is secondary to what we are actually using the assets to, could actually sit outside the operating profit. So I think reconsidering the split of what we have in operating and investing is something that would be worthwhile considering. And forgive me if I haven't found it reading through the standard, but by going through it, I missed some guidance on where do I account for changes in an earnout from a business combination. So if I have an earnout and I have to adjust that through P&L, is that operating or is it investing? It's probably not financing because it's linked to an investment. But if that is part of operating, would that then mean that when I have a really good integration, so I have to pay more in the earnout than what I considered when we made the business case for the acquisition? So now I have to increase the cost. So I have a much better business. I have a positive impact on my operating results with operations itself. But now I get a cost in that disturbs my operating profit because I have to pay more on the earnout and I have a higher debt. Is that really the picture we want to send? So I think there's a lot of items that are outside the normal core operation, and this is just one example that is not addressed enough yet on how do we want to present those with the classification in the 3 new groups that is being introduced. So I think those areas, and these are just some of the examples in the areas, are elements that we need a much more comprehensive discussion on. And in terms of making a really fair presentation of the businesses and the way we actually operate our businesses today.
Thank you, Tina. I think you really understand how to get a debate going and challenge some of the proposals. I'll give the floor first to IASB and see whether you want to react to this. I don't know, Nick, whether you want to start.
Thanks. Yeah, let me pick up a couple of points, and Aida may follow me. So yes, the subject around integrated and integral and non-integral associates and joint ventures is proving to be a controversial one. And I think the thinking here was really driven partly from changes again in business practice, that many preparers were telling us that some associates and joint ventures are now very much integral to their business. And I think the examples that we often hear about are in research in the pharmaceuticals industry, or perhaps in jurisdictions where you are not permitted to own more than 50% of the equity, and you don't have control for it to meet the consolidation test, but it's still an important part of your operations. So this was really a attempt to reflect changing business practice there. I'm not sure it's been that warmly received by preparers or by users, so it's probably an area where the board certainly has to give some more thought. I think there's nervousness, and we've had a number of people ask for it, this separate category within operating, which is for non-main activity operating items. And the worry I think we have is how to define that line. And already I've heard examples of things that I think I question why they fall into that category. And they seem to fall into that category because we just don't want to show them as part of operating. And we'd rather they weren't distorting our margin history. But equally, it doesn't seem to be so transparent in terms of being accountable for those items. Some of the items I've heard discussed, I think I would want to think, if they're not operating, why aren't they in the main business activity? Why are you doing them at all? So I think there's some issues there. It's interesting around wanting to reflect the matrix and the nature of businesses in terms of by function, by nature, how expenses are described, because actually that's really what users want. Users want the complete matrix. So you would break down every by function line by nature. That is their number one ask here. And so they're quite sympathetic to that view. And what we are proposing today, they already regard as a compromise in that respect. But again, this has been an area that we're hearing a lot of feedback from. And so I think, we will have to think about how we proceed here. We're also cognizant of some of the costs involved. So I think we understand providing that complete matrix would be extremely expensive for preparers to do. So we're sympathetic to that. Aida, do you want to pick up anything else in particular?
Thanks, Nick. I'll just add a couple of points and start again thanking Tina for taking the time to consider the proposal so thoughtfully and give us this feedback. And I think you make some fair points. I just want to emphasize to what Nick was saying. So the idea of the operating category and profit is for it to be a complete depiction to capture everything that companies do in operations. And you gave an example of disposal, and we heard, or the board's view has been that disposing of property equipment businesses is the normal course of business, and therefore it is something that should be captured as a part of operating. But this is also maybe the opportunity to highlight that the proposals in this exposure draft really build on each other, because it doesn't start and end with the proposals for subtotal, but we also have, because the subtotal proposals are complete, but then the board realizes that they maybe don't have as predictive value as when you sometimes disaggregate items that don't happen so regularly, which is why they dovetail so nicely with the proposal that we talk about later on unusual items, and they provide anchor points for proposals for management performance measures, where you would be able to take out the examples of the, earn out on business combinations and say, without this measure, I think my performance is communicated because of such and such. So it's really a package as a whole that the board felt provides a good balance and good information to investors.
Do you want to come in as well?
Yes, perhaps very briefly. I would have had the same reaction of Aida to say that the project is not only about primary financial statements, but it's about better communication. And the price for enhanced comparability in the subtotals is the fact that preparers will have to adjust their overall communication with the market. So they will have the flexibility of, for example, still having different line items for different type of revenues from the different business lines. They will also have the possibility to identify the non-usual items within the operating as disclosure, and to continue to use their management performance measures to explain what are the non-recurring elements, what is the non-core, etc. Of course, there will be more discipline around this. But for sure, what Tina has done is the type of feedback that we expect to receive in the course of our field test with the preparers.
Thank you, Chiara. I can see we already have a few questions coming in on the Slido, and thank you very much for that. We will try to take them and organize them as we structure the debate. And for your understanding, items like unusual items and MPMs, we are going to discuss that in detail in topic 3. By nature, by function, we're going to discuss that in more detail under topic 4. But I think we'll take one of these Slido questions now. If Jan Peter, I give the floor to you.
Kristian. So the one that has attracted most likes, which relates to the same here. Now it got away. It's back. It's one asking non-operating profit of integral and non-operating profit of integral associate joint ventures, however material to the group, would assume operating character in the proposed presentation. Has this been looked? Then it stops there, so I don't know whether it should be overlooked or looked at, but that is the question.
Aida, is that something you want to respond to?
Yeah, I'm happy to comment. I'm just going to interpret the question as I understand it. So I understand this as asking about the income taxes and the interest cost that will be embedded in the this share of profit or loss from integral associates and joint ventures. And if this is what the question is about, indeed, there were calls from some stakeholders for the board to basically disentangle these items across the categories in the statement of financial performance. The board has decided to not even discuss it in this project because it would really go beyond what the objective of this project is and what the scope of the project is, because that would really delve into what is the equity accounting and what it should present. So we are lucky we currently have a post-implementation review of the standards that deal with this. And, you know, in the future, there might be a project that will look into that. But just to highlight the actual existence or the net of this share of profit or loss of associates and joint ventures is really what has the reason behind the investors' call for the board to not classify it in the operating, and they are not classified in the operating. This is why they're a separate category, just to highlight that whilst these are close to entities' main operations, they can't quite be compared in the same way because the accounting is different.
Thank you. I'll give the floor now to David from Novo Nordisk. And I think that might be relevant as well, as we just understood from Nick, that part of the areas where, for instance, joint ventures of interest is in the pharmaceutical industry. And the obvious question, of course, is, David, whether that is something that is relevant for you. But I'm handing over now the floor to David. So please, David.
Fantastic. Thanks, Kristian. Yeah, so once again, just echoing Tina's comments, just thank you so much for the opportunity to participate in such an initiative. I think it's truly valuable to be able to share preparers' inputs during the process. So I guess answering the direct question on the impact of the integral associates and joint ventures, that isn't something that's applicable to us, and actually we don't have any significant results from either integral or non-integral associates or joint ventures. So actually, to a large degree, the investing category is not something that's material to us. So actually, for us, in respect of the sort of new subtotals and the definition of line items, the biggest impact by far will be the new guidance on the presentation of FX movements related to working capital items, and also the placement of hedging items, which are for us going to move from financing activities up into the operating category. At this point, we've yet to conclude whether that's good or bad news for us. but certainly it's the biggest impact, and certainly from a implementation perspective, particularly on when we present our expenses on a functional basis, there will be sort of the technology aspect of how we can then allocate those FX items, relevant functional cost line items. I would foresee for us that's where actually the overall biggest implications of the proposals would come, is on that technological impact, and then also what that has on a operating profit basis in terms of our sort of track record, trending, etc. What I'd also then say is coming back to the comments made around the disclosures related to expenses on by nature in the financial statements. Currently, we do provide, I guess, relatively extensive disclosures in certain areas around, particularly in respect of employee costs and depreciation and amortization, in respect of which individual functional cost line items in the profit and loss those items do get expensed in. And therefore, following Nick's comment, the proposal would therefore be a compromise, and therefore there's potentially the risk that there would be a net reduction in information being provided to users, because essentially that more disaggregated information that we currently provide would no longer be an explicit requirement, and that's clearly currently our present interpretation of what's being requested under current IS1 requirement. So from my perspective, I think there is a risk that there could be a sort of a net deduction from our perspective in that area related to useful information being provided. But I would say that I would be reluctant to do the full matrix, just to get that out there.
Thank you very much, David. So there's an issue around hedging where we would allocate that, and I suppose also a direct observation or concern whether this would actually lead to a reduction in net information. I think that would be a good question for the IASB. Nick, do you want to come back on that?
Yes, I'd love to, actually. So first of all, thanks to David and to Tina beforehand, I should say, for your comments. I think that would be a concern, but I'm also interested that clearly those three items, employee cost, depreciation, and amortization, as you say, are already required in aggregate by IS1. And I mean, it's interesting if it seems that those aren't too costly to allocate by function, and that then may provide useful information. Potentially, that's a way of tying up some by function and by nature information in a more coherent fashion than having potentially a by nature presentation that sits alongside a by function presentation. And actually, it's very hard to relate one to the other still. You still don't know. So I think it comes down, again, to clearly, obviously, costs and benefits, the utility of that information, and that has a different utility to providing a complete, by nature, disclosure of expenses, and then the cost of doing that. So, but yes, I think that's, for me personally, that I find that quite a useful way of presenting data and giving further information to users in terms of being able to allocate some of those, let's say, a limited number of lines into the by nature lines into the functions.
Yeah, because my personal view is I think just a total by nature cost disclosure doesn't really provide too much useful information to a user. It would be my personal perspective when compared against the functional line items.
Yeah. Well, I mean, it's interesting. We have some users, particularly, and it's interesting, it's particularly European users who really are asking for by nature information very strongly. It's a less of a feature in other markets, and particularly in North American users, but particularly European users seem to want to have it, but they wouldn't want to at the same time lose the information that you're providing today, no doubt. So
Nick, maybe a follow-up question, because I saw one of the Slido question is maybe addressing this and say, what is the basic objective of the financial reporting? Entity-specific reporting, reflecting how the entity is managed, or fixed comparator reporting? And I suppose that's a tricky balance you're fighting.
Yeah, and that's quite a big question. But what I would observe, and this is really quite big pictures, in terms of financial reporting, one of the big changes I saw over the course of my career is that money was being and is increasingly being managed on a global and international basis rather than on a domestic basis. And so, you know, and people are rarely having, particularly on the buy side, fixed lists of stocks to look at. You're moving from one country to another, from one sector to another. And there's a huge, there's a huge inefficiency that I spend the first 2 hours when I look at a new company, trying to work out where things fit into the P&L. You know, where are the associates and joint ventures? Are they in operating? Are they outside of operating? Where is the finance income on a pension liability? Is it in operating? Is it in financing? And our research, we looked at 100 different companies. We found 63 used operating profit, and within there was 9 different definitions. And probably the most troubling thing is that a number of people that we have talked to that we would thought would know believe that this line is commonly defined today. They just think it's the same from one entity to another, and that's actually quite troubling, I think. So I accept that there is a trade-off. I think some of the other things which we are doing around MPMs in particular recognizes the importance of entity-specific information. But equally, I think the world has changed, and we've had such a positive response in terms of having some more structure to the P&L that, as I say, users have asked for many years now.
Thank you. Aida, do you have more to add, or Chiara, before we?
I do, Kristian, but I would suggest perhaps we move on. I don't have anything substantive to add at this point.
Okay. Chiara?
Well, I concur perfectly with Nick on the trade-off between comparability and entity-specific information. So what we're trying to do is to make more clear the situation and avoid the confusion today, because we have an illusion of comparability. We use operating labeling, but there are different meanings behind this.
And I know that Tina has a comment specifically on this again. So Tina, the floor is yours.
Yeah, an element that we haven't touched on, but which is very relevant in terms of what you said, Nick, how much time you spend figuring out how a company report different elements when you are going through and assessing operating profit. I think we need to consider, where do we as users put our investment? Is that when we, for the first time, is looking into a company and we get to know it? So there we have to spend time to figure out what are the company-specific details, not arguing that we should not do some standardization on this, versus what is the benefits of having operating profit being, could I call it, a bit more core operational, not leaving everything as unusual, but being able to report that differently than what the proposal says now. Because that might be a much better way forward with the data that we report on day one, going through machine learning and analysis. So a lot of the first impressions whenever we report as companies is coming out of machine-read analysis, and that is what is hitting the headlines. So how do we strike the balance between the maybe wrong interpretation, because some one-off transactions in a given year that impacts our operating profit, that is hiding in, let's say, cost of production. So you can't see that. So you might get the first interpretation wrong, versus the investment that the reader have to do the first time they are getting to know a company. And I think that is one very key element, because you're absolutely right. We need to think differently when we report, but the machine learning reads the numbers and not the details that we can provide on page 5 when we are past what is the core business development. And I miss that kind of discussion on where are we today and how is financials reported or should be reported today, but also where will we be in 5 and 10 years' time, and where are we moving in terms of electronic use of our data, statistical information, and a lot of analysis made in the second we report to the stock exchange.
I mean, I'm happy to respond. I understand exactly what you're saying, and I'd say I was one for spending a lot of time, initially researching a company. I was a very research-focused money manager, but nevertheless, it's hugely frustrating on some of those very basic items. Is this a below or below? Is this an operating profit or not an operating profit? To have to just, it's almost. I'm loath to use the word, but I always feel like I was wasting my time having to consistently see where is this pension financing item? Is it in operating? Isn't it in operating? Is the associates in operating or not in operating? I think one of the issues we have, about drawing the line, let's say within operating between those related to main business activities and others, it's actually very hard to draw that line on a consistent basis, and I think that's one of the things where we've ended up with this as a residual, so we have a tight definition of it because we don't want things sort of seeping out and another category being created. I also recognize, and perhaps not all board members like this, but non-GAAP is part of the reality of the world today. I think there was a study from PwC that showed 93% of companies, large companies, use non-GAAP now. That's often what drives the headline, and that's then the opportunity, perhaps where in a preparer, a company may want to highlight something that they don't consider to be persistent or as a one-off through that mechanism.
Yes, thank you very much. And I think we'll definitely come back to the non-GAAP issue in one of the next topics. But I think it's an important question on how we are going to consume the data going forward and ways of consuming. But maybe if we turn our focus to our third preparer that we have here lined up as well, Nikolai from Ørsted. Big energy company. So Nikolai, I give the floor to you.
Yes, thank you, Kristian. And as the other said, thanks for inviting us to give inputs in this important dialogue. I think the disadvantage of being third in line, I hope you can hear me. But I think the disadvantage of being third in line, it's that most of the points are already mentioned correctly.
Yeah, you are on and we can see you.
Okay, sorry. I can try again. So I think to make it short, most of the inputs that we have thought about when reading the proposals have been mentioned with the way we do business and enter into partnerships and joint ventures, joint operations, etc. We see a lot of our profits being on one-line basis, and we don't have that many integral associates or joint ventures. They're not that significant right now, but I guess if the consolidation practice becomes the question here on how we should present our joint ventures, if we could present it as part of our operating profit going forward, if it becomes material to us, I guess a route that we would pursue would be to include management performance measures or an additional EBITDA, including associates, so we can still talk about our operating profits in a meaningful way, including associates if they are significant to us. I think that's one of the things that we, on top of all the discussion inputs given so far, which we also agree on, that's one of the things that we might pursue in case it becomes material to us, obviously.
So Nikolai, as I understand, at least there's one thing, namely the EBIT and EBITDA lines or subtotals that you currently use. I know we're going to discuss management performance measures later, but I think it would be relevant to see how do you see EBIT and EBITDA fit in under the current structure. Would you be able to fit them in the line items now as they are proposed?
Yeah, I guess with the operating section and the, I would say, possibility to arrange the operating section in a way where we can show a meaningful EBITDA or this proposed IFRS specific matter, or not matter, but subtotal, it is to a large extent the same as EBITDA, which we focus a lot on today. I think we can, in a meaningful way, continue doing our reporting. But again, if the associates become more, you can say, more significant to us, we would start considering maybe doing a separate or additional performance measure where we could include the associates. I think that's one thing, at least, that we would consider when implementing. Then, the gain on other non-operating transactions, divesting enterprises, etc. That's something we have to dig into and be sure that that's also a part of our operating model, that we construct projects and we divest in them. So finding a meaningful way how to include that in our operating section, that's also something that we need to look into.
Thank you. I have also a question on the Slido. That's actually regarding tax. And it states today we allocate tax between the profit and loss and the OCI. Have the IASB considered allocating tax further to operating and financing in the profit and loss? I think that would probably be the final question under topic 1 before we just move on to topic 2. But Aida or Nick, any reactions, comments?
So, Kristian, so it's a very quick answer, no. I mean, I do recall in outreach with some investors, they did ask for some disaggregation of tax, for example, to show the shielding effect of some items in the financing category, but the board has not had significant demand for this, and therefore the proposals or what is currently there and presented as income tax would not be changed as a result of the project.
Thank you. Actually, that just another important question came in before we go on to topic 2, and I think that was highlighted as well in EFRAG's initial reaction, namely, what is the IASB's reaction on the concern regarding the use of the same labels in the income statement and cash flow statement, though with different definitions? So I think that was what Chiara had on the EFRAG slides, saying that we state operating, investing, and financing, but the definitions are not similar. So I think that's a very principal question. Nick?
There may be a question of labelling here. I think it's been well understood for a long time that they do have different purposes, and you know, some people ask for alignment, that they'd like complete alignment across actually the balance sheet, cash flow statement, and the P&L. And the previous project, the financial statements project, I'm sure many of you remember, explored that through the subject of cohesiveness, and in the end that didn't take off. And there's some difficulties with that. So you find some items which may be in one place, a single place in one statement, but then have to be split between or straddle two categories in another statement. I also think that some users think about investing, particularly in the cash flow statement, differently, in that they think about that, I generate some surplus funds. What are the investment opportunities for that, which could be organic, it could be into associates and joint ventures, it could be into M&A, and that's how IAS 7 expresses investing today. So we probably do need to go back, particularly in the investing section, and think about whether we need to do something on labeling there. There are still voices, and I think where we hear for more alignment between the three statements. And then when you then go and ask, and this was work that was done by the FRC, I think in the UK, and they suggested alignment, and they suggested CapEx, for instance, should be in operating in the cash flow statement. You then hear people say, oh, no, we don't want that though. And so there's a sort of a bit of a mix. We'd much rather have CapEx in the investing section in the cash flow statement. So I think there's possibly some further work to do there. I think on the cash flow statement, we're making tactical changes to that in this project. That was a decision of the board. Let's bank the gains that we're making already. I suspect through the next agenda consultation process, there'll be requests to look at the cash flow statement again.
Thank you. I think we will probably advance now to the topic 2, which is closely related to the topic 1 we've had, namely looking at the new subtotals. And before giving the floor to the IASB to introduce it, I'll actually ask you to consider a question as you go along with the presentation. It's one of the slider questions, and it suddenly disappeared from me. It's here. It's what about the confirmatory value of the operating line given conceptual framework focus on stewardship? Has that been explicitly given a thought? And I think that's relevant when we try to look in the topic 2 about new subtotals and the impact and how it will work on all industries. So, and to kick this off, I think we actually have the question on the screen now, but I'll give the floor to the IASB to introduce the key topic 2. And if you could give it some thought while you do the presentation, I think that would be appreciated. So, Aida, are you taking the lead on the presentation?
Thanks, Kristian. So I will run through. So let's look back at the slides and look at slide 18. That shows us an example of how proposals would apply to financial institution. And here example is showing us investments in retail bank. And I think you can quickly see it doesn't apply quite the same as in our general model that we discussed so far. And the reason for that is the board quickly realized that if they were to propose to apply the general model to financial institutions such as banks or investment companies, it would not really result in useful information, because what it would mean is that someone like a bank would present interest expense in the financing category. They wouldn't be able to present one of the key metrics of net interest income within the operating profit. And they didn't seem particularly useful outcome. And also it wasn't aligned with the board's objective to have operating profit that includes all income and expense from main business activities, and therefore that captures these key operating indicators of operating performance. So how the board has addressed that? So we have 2 principles that are based on main business activities in the exposure draft. And the first is a principle that entity that has a main business activity, so a main business activity, not a single activity, of providing finance to customers. So this captures banks. This also captures, say, manufacturers that give loans to their customers as well. Then those entities will be required to make accounting policy choice to either move all of their essential interest expense, what we call expenses from financing activities, up into the operating profit, or only move those that relate to provision of finance to customers. So we expect somebody like a car manufacturer could be able to easily distinguish which interest relates to the lending business and which interest relates to manufacturing, so they would only move the lending business up, whereas maybe some banks it will be more difficult and they would perhaps move everything up, which is what this example illustrates here. So in this example, entity has moved all of the interest expense in the operating, which is the line item you see highlighted in green, and therefore net interest income is presented. Again, I want to highlight this is an illustration and none of these are required line items and don't necessarily represent how entities might apply the proposals. So that was the first principle. The second principle relates to main business activities being to invest to basically earn income and expense from investments made in the course of main business activities or as a main business activity. And entities that do that, then they would be required to move those income and expenses from investments into operating categories. So in the slide here, you see the two gray line items, net trading income and investment income, so they would otherwise be in the investing category. They are moved into the operating category. There is no similar accounting policy choice here because the board thought the entities could identify which investments are made in the course of their main business activities and which aren't, and therefore could move everything up to the operating. And the final point here to highlight is you can see in this example, entity does not present profit before financing an income tax subtotal, which is one of the three new proposed subtotals. And the reason for that is when entity moves all of their interest expense up into the operating, then that subtotal will become meaningless and even misleading. And therefore, it wouldn't be presented, although to highlight that these entities would still be required to present time value of money on their non-financial liabilities, so the pensions and provisions below operating profit, just like any other company, but there wouldn't be separate financing categories, so to speak. So this is my summary of the proposals, and I think Chiara was going to go through EFRAG's initial views on this.
Yes, thank you. So if we move to our slides, just a moment that I have to go on the right page, yes. Of course, we could say that the devil is in the detail, and this is the area where really we need to test in practice the dividing lines of the different categories. As I announced at the beginning, there are few topics for which we are seeking views, and we still don't have a firm position. And this includes two important items which the IASB, we could say on a conventional basis, is proposing to include in the financing. The income and costs for cash and cash equivalent and the time value of money. In our discussions, there were split views, and in particular, whether these two items should be in the financing or elsewhere. For example, cash and cash equivalent into the investing category, while the time value of money was perceived not to be related to the financing category. So we would be interested in hearing constituents' views on this. Another point where we are consulting the constituents is on the practicability of separating the returns from the investments made in the course of an entity's main business activities from those that are not. And I think it was already mentioned by Tina, the challenge of splitting this component, and also how costly in practice would be to split between operating and investment. From our discussions, there was clear support for the dividing line between operating and non-operating. But when it comes to further going to the non-operating and trying to split financing and non-financing, this is perceived to be now the real challenge, because To some, these sound, at the beginning at least, as arbitrary or not perfectly clear at the moment. So as for any new concepts, is to be seen in practice. For the exceptions, the investing activity, for example, is core part of the business for insurers. So the investing will be included in the operating category. Same for the banks, where the financing is integral part of the operating. So, of course, we support these exceptions. But we see as a challenge the application of these proposals in the conglomerates. Conglomerates, we mean entities that operate in more than one business line, for which there may be a different dividing line, operating, investing, and financing for the different segments. And considering the impossibility to use a column approach, we would be really interested in understanding how, in practice, this could be dealt to still keep the relevance of the different components. And Aida was mentioning a choice, entity policy choice, which is available, where entities operate the financing to the customers. We discussed this option, and we felt that the example of a car manufacturer that also does financing, we still see that it wouldn't be appropriate to have all the financing into the financing category, into the operating category. This would be relevant only if the financing to customers is really the dominant line of business. Otherwise, it would be still important to understand how the manufacturer side of the business is financed. So this is another point that we have in practice. We are asking to constituents input and support to understand how in practice the issue of the conglomerates would work. And if, for example, some more guidance should be provided on how to disclose which approach has the entity taken to divide when there are internal transactions among the different segments, how the margins have been allocated. We think we have a question to constituents whether they feel something more in terms of discipline should be considered. Then another point is the application of these dividing lines at a separate level versus consolidated level, where, for example, the relevance of the different segments may be different at consolidated level or at separate level.
Thank you very much. I know we have a few questions already lined up on Slido, but maybe we could take the poll first we have on Slido, as I think that will be relevant to start the debate. Basically, whether you think it's feasible to make the distinction between investing and financing for all industries. So if you could please turn to your Slido. Now I can see some answers coming in. So probably while we have the polling going, if I turn to Jan Peter and ask him whether he could, in the meantime, ask one or two of the questions we've received on Slido, then we'll pick up on the result of the poll. Already now it seems to be a little bit blurred. So Jan Peter, the floor is yours.
Thank you, Kristian. So there are some questions around this we spoke about. There's a question in section 49A. Part of the financing category in the income statement is income from cash equivalent, for instance, investments. Why are they not part of the investment category? That's one question. And there's another one. which also relates to section 49. It's 49C. It is not clear what items are included under financing. All unwinding included in IFRS 15 discounting effect, question mark, is that included? Could we have maybe a little further elaboration on that?
Sure, Jan Peter. So let me answer those questions. Cash and cash equivalents is one of the proposals where I would say it's a kind of compromise solution the board has achieved, because clearly cash is used for different purposes in different businesses, and it's fungible. So it's sometimes quite unclear to say, it is this, it is that. It can be used for many different purposes. But the basis for the board's proposal in the exposure draft was that it's a good proxy for excess cash and cash equivalents that companies would generally, or users would, when analyzing performance, would generally offset against finance costs or treated together in a bundle. And on the basis of there already being definition of cash and cash equivalents, this being term that is widely understood, this approach was adopted. So it's a kind of proxy for this excess cash that would be considered part of the treasury that would be analyzed. So it is not a precise, of course, the precise approach would be to either define or allow companies to identify which part of cash is their working capital cash, which part of cash is not. But it was felt that the costs of this approach would really are not justified by the benefit that would be obtained, and therefore this kind of proxy approach was adopted. And on the second question, on the qualification of what goes into the financing category, so it's very much driven by, so financing category pretty much is all about liabilities with the exception of cash and cash equivalents. And anything that the basis for expenses from financing activities is our proposed definition of financing activities, which elaborates on definition that is already there in IAS 7, which talks about, being results of a provision of finance from a provider of finance, and there is a finance charge payable, and there is a time when this will be paid back. And it is really that definition that is applied, and on the basis of this definition, you could have some of the trade items that are classified as trade payables actually meet the definition if you receive a financing from your supplier, and similarly, if you receive perhaps a prepayment from customers, there is a clear financing component, you can go there. On the other hand, when you have a receivable, then that could be considered to give rise to income expense from investments rather than being operating, but it wouldn't be able to be classified in the financing category because, as I said, financing category is really about liabilities with the exception of cash and cash equivalents. And Jan Peter, I know Kristian said earlier there was a question about stewardship. Did you want us to discuss that now, or do you want to cover that later?
I think I can take that. So the question is, what about confirmatory?
Yeah.
What about confirmatory? You have the question there. I just want to read it out. What about confirmatory value to the operating line given conceptual framework focus on stewardship, if that has been given a thought?
Thanks, Jan Peter. So the question is really about the link between the operating profit and the structure and the stewardship. And I was actually really happy to see when we spoke to users of financial statements that they very much saw the way the board has defined the categories and subtotals, including operating profit, that really gives them information about stewardship, because these categories are complete and include all income and expense that have arisen that that management has incurred in the period, and this includes our examples of disposals and true-ups and the like, and recognizing that this somehow takes away from predictive value from some of these, because there are items with different predictive value. But on the other hand, it really helps stewardship because it holds management to account by recognizing everything that has been incurred in relation to operations into this operating profit subtotal.
Thank you very much. Maybe since we now have the result of the poll, which I don't think gives you a very clear answer, there's a slight majority saying that it's not feasible to make the distinction as a uniform definition will be difficult to apply, and you have the answers here on the screen. There also the dividing line between operating and non-operating caused a few hits, so doesn't seem to give a clear picture. And maybe Nick, I can ask you, and then Chiara afterwards. What are your reactions to that? Was that what you would expect?
Well, I think the example that Aida talked around the treatment of cash and cash equivalents shows you from a conceptual basis that it's impossible actually to define it conceptually, because cash and cash equivalents, depending on whether that's the cash you need to run your business or it's surplus cash, straddles investing and financing. That is just the reality of it. But I think that the board, as Aida said, talked about splitting that. Should we ask for entities to split that? But there's so much judgment involved in that. Entities don't actually know the precise split between the cash required to run their business on a day-to-day basis for working capital, and that ebbs and flows from day to day, obviously, and what might be considered to be surplus. So I think it is conceptually, it's impossible to split, to say, that you allocate things to these categories, but recognizing that cash and cash equivalent will actually straddle investing and financing. In some respects, you can think of this as being a spectrum. However, there is a great utility from actually, on a consistent basis, always knowing where to look for it in the income statement. And that's the utility. And because, again, users aren't asking for us to split it, but they're asking for it to be in one place. So I think we accept that there is a degree of arbitrary allocation here, that we've chosen to put it in one particular place rather than another, but we don't think there would be value in following a purely conceptual line from a cost-benefit basis of asking for it to be split between two categories, for instance. So I accept there's some pragmatism here.
Thank you. And Chiara?
Well, I think that the question was the right one on the basis of the results that we are getting, because indeed also from, as I anticipated from my introduction, also from our discussion was not clear how to split between financing and investing. And in practical terms, many thought that what mattered was the operating, non-operating. So I think this feedback is consistent with what initially I've heard. And then, of course, as Nick was saying, there is an element of arbitrarity between the financing and non-financing, and there are a couple of items where we are curious to see the feedback from the constituents before we conclude, including cash and cash equivalent.
Thank you. And I think since we're now warmed up to have a good light topic, we'll move on to the next topic, topic 3, which is the management performance measures. And I'm quite sure that you have received some reactions. I'll give the floor to Nick. You will lead us into that topic.
Yes, thank you very much. So these are our proposals, as you say, around management performance measures. We may also call them non-GAAP measures of financial performance, but it's the terminology management performance measures that the board has landed on. And our proposals here very much build upon the ESMA guidelines that you'll all be familiar with around alternative performance measures. They apply to a narrower set of measures, so these are focused on those key measures of financial performance that are subtotals of revenue and expenses. And I know the ESMA guidelines apply to a broader set. But as I say, they very much build on them. So at the heart of it is requiring a reconciliation to an IFRS defined subtotal. And as Aida pointed out at the start of our discussions today, this is in many respects a package of measures. So providing more subtotals in the P&L statement provides more anchor points to reconcile back to. So if you produce an adjusted operating number, there is now operating profit, an IFRS operating profit number to reconcile back to. It like ESMA, requires an explanation of what's included in that number and why, to highlight any change in that number from one period to another in terms of the basis of the calculation. In addition, there are a couple of further things that's done here. We have asked for these all to be provided, all of this information to be provided in a single note in one location. And again, that's a frustration that we've heard from many users, that they don't know where to find this information today. It can be, sometimes it's in the financial statements, sometimes it's in the press release, sometimes it's in the presentation pack, many different places, and they'd like to be able to find it in one consistent location. And so that's, I say, important that they find it there. We've also asked for, in terms of the adjusting items, information on the tax and non-controlling interest effect of those items. And again, that's very much a feature of the buy side in my experience. I want to take that number, I want to interrogate that number. I'm very interested in what the number is. I don't want the board interfering in what should be in a management performance number. I want to understand what the company believes is the key performance metrics, but I want to see, does that align with my own beliefs? And actually, I may want to make some adjustments to that number. So having the tax and NCI effects allows me to adjust that number myself. And again, that's being very well received by users, an important element of the proposals. Just moving on to the next slide in terms of what is an MPM and what isn't an MPM. As I say, these are financial performance measures. They are subtotals of income expenses. So on this slide, we include some examples of what would be MPMs. But clearly, there are a series of subtotals now that are IFRS specified and hence aren't MPMs. And one that we have specified is something called operating profit before depreciation and amortization, that may be thought of as an EBITDA definition, and is what some entities would use as an EBITDA definition today. What's excluded are non-financial measures and also measures that are not subtotals of income expenses. So let's say measures of free cash flow, return on equity, net debt. For me, I know there's been some discussion around this, why have we chosen this subset of measures as MPMs? I think these are probably the most important MPMs, those that convey financial performance. They are often the ones which are the headline in a press release when an entity announces its result. And I think this is where we've heard most demand from users. So I think it complements the rest of the proposals we're making. I think we found it's been very well received. And as I say, it very much builds on the ESMA guidelines that have been in place for quite a number of years now. And separately, on the next slide, we also have a proposal around unusual items of income and expense. And again, this very much reflects user requests here. Many entities produce lists of non-persistent, non-recurring, one-off. Some will have a list of what they call adjusting items, some of which may be recurring, some of which may be not recurring. We have frequently seen restructuring costs in some industries run from year after year after year after year. And so I think what has been asked for is for a definition that has a high bar. And so the definition that we have come up with is items which have limited predictive value, and so not expected to occur for several future annual reporting periods. Some will like us define what we mean by that, but I think the board discussed that and is wary in getting into the mechanics of being very formulaic, saying that you can't have things that appear, more than 2 out of a 5-year period. We want some more judgment around that. And attached to that definition of unusual items, I say these will be disclosed in the notes, will be some information which ties that back to the line items in the statement of profit and loss, and also some further information where they appear by nature if you report by function. So I will stop there and wait to hear back from others in terms of these proposals.
So we give the floor then to Chiara.
Yes. So on management performance measures, this is one of the topics that attracted most of the debate, or a key part of the debate. We support the efforts to provide this guidance and to introduce discipline, as the management performance measures are very often used in practice. And so this could bring more transparency and consistency on their use. As Nick was saying, in Europe, we have familiarity already with the concepts of management performance measures because of ESMA guidance. But ESMA guidance do not only relate to subtotals. So we suggest the IASB to consider also other non-GAAP measures within the same requirements of the MPM, like, for example, also some ratios which are often used, and not to limit only to the subtotals. In our letter, we also identify a number of challenges in regard to the IASB proposal, and we are seeking views of constituents on a relevant topic before taking a position on the IASB proposal. What we know is that the problem related to transparency, consistency, quality of information, clarity of the labeling is mainly occurring in the outside the financial statements, I would say. So the ESMA guidance apply to MPMs that are used outside the financial statements, like for example, the press releases, announcements of the returns, presentation to the analysts, and management commentary. So the key question to our constituents, and would be really interested in hearing also from you, is the geography and the scope of application of this proposal. Should the new requirements of the IASB to disclose the definitions and the full reconciliation, should these be limited to the MPMs that the entities choose to disclose in their financial statements, or should they be extended to all the management performance measures that are used in the communications issued jointly with the annual or interim reporting, including the earning releases? Now, of course, behind this question, there is a philosophic view of the financial reporting. There are those that think that items that are in financial statements should have the right quality, should be audited, of course, and therefore see the potential broadening of the population of managerial indicators that could enter into the financial statements because of a broader scope. They see in these a risk of compromising a bit the clarity of the readability of the financial reporting. But from another hand, we have just heard from the discussion that moving to a more structured profit or loss, where in operating you have everything, like as Tina was saying, you have the core and you have the non-core. This may create more appetite for a need to introduce a new MPM to continue to communicate what is core and what is non-core. So one of the questions that we are also having, you see here in my slide, is whether you believe that the proposals on the structure and content will result in having a higher number of MPMs or lower number of MPM. And then another relevant question to the preparers is the cost and benefit of the reconciliations and of splitting the tax effect and NCI for each item that has to be reconciled. With reference to the unusual items, I think we already heard about the need to identify items that will be now all included in the operating and that may have lower predicted value. So we welcome the proposal of the IASB. We think it will help because we often see reconciling items which have a less predictive nature, which are broadly used by the entities. However, we discussed a lot on the definition that the IASB has chosen, because it is focused on items that will occur only for a limited period of time in the income statement. So, for example, we thought about the definition of restructuring costs. The restructuring processes are not going to be predictive in value, but last for more than one period. So they may occur in the future, and for these may not follow into the definition of the IASB. But nevertheless, we felt that they were unusual. So some more thoughts should be given to this definition to capture the right population. Some of our constituents also said that the translation of unusual in their jurisdiction may raise issue because it may be forbidden to undertake unusual activities in some jurisdictions. So this was also an element which was considered. So another question that we also had, and we asked the IASB to clarify, is whether an entity could present on the face of the balance sheet an item labeled as unusual. This we asked the IASB to clarify. I think this is all from my side on this.
Thank you very much. I'll give the floor to Nikolai from Ørsted for comment, and I will also ask you in the meantime, there's already a polling question active in the Slido deck that you can answer, especially around the polling question is there. So you can consider that while we turn the attention to the intervention from Nikolai, and then we'll circle back to this question. But Nikolai, the floor is yours.
Yes, thank you. Am I on, Kristian?
Yes, you are on, at least with voice.
Yeah, thanks. Yeah, so I guess it was also the comments just made by EFRAG. What is the scope of these unusual items? Today we don't adjust our management measures as such, but obviously as most companies we have unusual items once in a while, and we mention those in our management review. So this would obviously be an increase to the disclosures we have to make in the future. So maybe, yeah, it was elaborated a bit on during the presentation here, but maybe if it could be elaborated a bit on what is the scope here. It seems like it's very comprehensive information that we need to give when we look into the examples in the exposure draft. So what is there a threshold? What is the thought here? Because it can be very comprehensive if we start to disclose a lot of things and have to write about a lot of adjustments.
Thank you. A fairly direct question, Nick or Aida, do you want to come back on that?
Hi, I just want to see if Nick wanted to respond. If not, I'm happy to comment.
That one to you, Aida.
Okay, thanks. So thanks, Nikolai. And did I hear you correctly that currently you don't have management performance measures or non-GAAP numbers as such, but you identify sometimes unusual income and expenses? Is that right?
I don't know whether Nikolai is still on.
Yeah, we might have lost him, but I just want to maybe use this opportunity to clarify that proposals for management performance measures do not mean company has to have management performance measures. So this is very much about providing discipline and transparency to the measures that company uses in communicating their performance to investors in their public communications. And if company communicates with investors using IFRS specified subtotals, then that transparency is already achieved because the IFRS standards define what those subtotals are. Investors know what is included in them, why they're useful, and so on. So whilst, Nick quoted research to us that most companies do currently use non-GAAP measures, there are some that don't, and what these proposals mean is the companies would not be required if they don't use these measures in their public communications. They wouldn't be required to have them. On the other hand, proposal for unusual income and expenses would be mandatory for all companies to apply and identify whether they have any unusual items. As explained by Nick, the threshold for this as proposed in the ED is quite high, so it could be possible that companies don't identify any, but nevertheless everybody would have to apply this, because the view was that regardless of how entity communicates its performance, the information about income and expenses that have limited predictive value is useful to users in all circumstances. So I hope this answers Nikolai's question, but perhaps when he comes back online, he can comment more.
Yes, absolutely. And I can see we have also a follow-up question on the slide that given the challenges in defining unusual items, will comparability be achieved? And if this is doubtful, are the proposals on management performance measures sufficient for transparency?
Thank you, Kristian, for this question. And this is really going into the reasons why the board is having these two sets of proposals. So management performance measures proposals are there for transparency and for discipline around non-GAAP. Unusual items are there to help users predict future cash flows, regardless of whether companies have MPMs, don't have MPMs, and what items they adjust for in their MPMs. So, of course, done in transparent way. So in a way, it is objective. But I think it's fair to recognize that it's quite a judgmental definition of unusual income and expenses. But at the same time, the threshold is quite high, and it's high on purpose. I think, as Chiara said, there is a lot of feedback on this, and there is some demand for the board to consider expanding what would meet definition of unusual. For the example of restructuring that perhaps goes over 2 or 3 reporting periods that currently wouldn't meet definition of unusual until it comes into its last period. But then I would argue also, please consider the moment you expand, then this comparability or consistency of application is also, I would say, becomes jeopardized in a way. So the board on purpose went with this narrow kind of high threshold of what meets unusual items. And I have to say, from the users of financial statements, the feedback on this has generally been positive, that they do like high threshold, because some of them are reported to us that they are a little bit tired of seeing restructuring classified as unusual item year after year after year, and they report companies doing this for like 20 years. They've been following them with. So there has to be a balance, and I'm sure we'll have lots more discussion on this topic as we come to the board and redeliberate.
Thank you. I think we now at least have some sort of a guidance on the polling question in relation to the management performance measures. And I think the good thing is that everyone believes it's important to explain the overall performance through management performance measures. I think the other side of the coin is the fact that only 2/3 believe it will actually allow businesses to make the link, and 1/3 saying that it's going to be difficult with the new structure. And I suppose if I look at one of the questions on Slido, it's sort of related to this, because there's also the question that came in quite early, actually, asking why did you prohibit extra columns in the profit and loss? Maybe this could be used to present management's views on performance next to the standard presentation. And I suppose that's a fairly principled discussion and question. And I don't know whether, Nick, do you want to come in on that? And then I'll give the floor to two of the other preparers.
Sure, absolutely. I mean, first of all, just to comment on the result of the Slido poll. I'm quite surprised that so many, 31%, don't believe that it will allow a link to the entity's view of the business, given that the board has completely put no constraints around what can be included in a management performance measure. It's absolutely up to the entity, as long as it is a subtotal of revenue and expenses. But heartened by, most think that it will allow that communication to happen. So that's good news. In terms of, sorry, just remind me the second issue. It's completely gone from my mind now.
The second question was around why did you prohibit extra columns in the profit and loss?
Yes, thank you. Yeah, got it. Thank you. So the only place where we see columns used extensively is in UK accounts. We haven't really seen columns used. We have only said that they can't be used for management performance measures. And I think part of it is that this has turned out to be a very emotive subject in terms of bringing non-GAAP into the financial statements. And we find from, the attitudes vary enormously between one jurisdiction and another in particular. Some have the view that these numbers should never be reported anywhere in the financial statements, perhaps apart from in management commentary. And others take a much more relaxed view about it, and already entities in those jurisdictions will regularly report these numbers in management commentary. And indeed, that split has been apparent within the board as well. And I think where people got particularly emotive and concerned was that all of a sudden that the primary financial statements, these would be littered with management performance numbers, where these should be IFRS numbers. So I accept it's an element of compromise. Where I've seen examples by companies today of a very good reconciliation, and that goes back to the NCI and tax effects required for the adjusting items, is affect a columnar approach using columns across, the entire P&L, and that appears in their notes. So I think that's something which we need to think about. That's something which could be encouraged within the notes, to use the columns to not only capture the information about tax and NCI, but also to make it very clear how the reconciliation works. And then just briefly, I know EFRAG have raised some concerns about the cost of those tax and NCI amounts. I think clearly any company that is producing an adjusted EPS number must have calculated those amounts already. I can't see how they could have possibly produced an adjusted EPS number without working out the tax and NCI effect of each adjusting item to get to an EPS number. So I think many entities are doing it already to come up with an adjusted EPS.
Thank you, Nick. I give the floor now to David, followed by Tina.
Yeah, thank you. So I guess first of all, starting off on the MPM, from a personal perspective, I'm supportive of there being assurance on MPM. I think that's to the benefit of users. I guess my overall concern would be the inclusion of only a subset of APMs within the scope. I think if we're looking at it from a user perspective, they will look at the annual report as a whole, and where companies are providing the reconciliations under the ESMA guidance, which we currently are, the proposals would therefore then result in those reconciliations being placed into separate parts of the annual report. Certain of those within the scope of the ED would be in the financial statements, and then sort of the more cash flow related or balance sheet items would be outside of the financial statements potentially. And then I guess there's also the elements where the scope only includes those MPMs related to subtotals, and therefore if there are any APMs related to line items or ratios, as previously sort of mentioned from EFRAG, then those also would be outside the scope. So I think there's the placement issue, which then creates a sort of a barrier to usefulness to the user. And my personal preference would to have them all in one place, and to the extent there can be assurance on those, and then that must be a benefit. But I guess if there are certain ratios that are made, so for example, we disclose sales in constant exchange rates, those are clearly not an IFRS measurement issue, but could it be in the scope if the measurement adjustment was explained and reconciled? Could those sort of non-GAAP measures also be included? Then on the topic of unusual items, I think my concern here is just what the implied information value about whether an item is unusual or not unusual, and what that means in respect of expectations of would this item happen again in the future, and how that links to inherent risks within a business model. So I guess talking about it from a pharmaceutical perspective, where you might have intangible assets on the balance sheet, and where those assets are in development, trials running, then there is always this inherent risk of impairments on intangible assets related to the outcome of that clinical development. And certain of those impairments could be material and therefore warrant disclosure potentially in the unusual category. But by including it as unusual, are you therefore implying that you are not expecting any other impairments on any other clinical development programs in the foreseeable future? Clearly, we'd hope that would not be the case, but it's difficult to assure that would be the case. Conversely, by saying it's not unusual, could that just be covered by the inherent risk in the model? And you're not making any form of assurance or interpretation as to the likelihood of that event happening again.
Thank you. Thank you, David. Tina, do you also have a brief comment before we turn to IASB?
Yes, please. Thank you, Kristian. I think another kind of example where David just described how we might need impairments for different activities within the pharmaceutical business. What you also have to think of is what is the real business, because with the discussion we have and the arguments are here for how the draft standard has been thought of and how that should actually regulate the way we report, seems to be very, very simplified in the terms of how we actually operate and how we drive our businesses. For businesses that do invest in emerging markets, in countries that are developing, you have to remember that part of the business case when we invest is running restructuring programs, not just right after we do the investment, but for 5 or 10 years. So when we buy a brewery group somewhere in a developing country or countries, we might buy 30 breweries, knowing that in 10 years' time we will have less than half of those left. And the cost of that in some years are of such a magnitude that that would change our operating profit by plus minus 10 percentage points, just that item in itself. And if you put all of that into our cost of production, it will change our cost of production with 5 to 8% in certain years. Because it's not a natural flow. It's not like I take out one brewery every year with exactly the same cost or close to the same cost base. But you would see significant impact on reported numbers if we are not allowed to take those kind of non-core activities and present in certain lines. I don't mind it being within operating profit, but what I mind is if we have to put it into the normal lines, because I'm absolutely sure that it will skew information and it will be hard to find it, just as it would in the example of the pharmaceutical business. So we need to think of what is normal within a business operating over a period of time in the world we're in today, and what kind of investments companies make just to keep growing, keep developing, and not just what do they produce and what is the output of the day-to-day production. Because I think the view right now is way too narrow and too focused on what is the day-to-day output versus what is the business environment we actually operate in.
Thank you. Nick, do you want to answer?
Pick up on a few things there. I think first of all, the things David raised. I think the question of scope is one which we can debate. I think in some respects this is us taking some tentative steps into this space, and it's been very, as I say, it's been very controversial. I think the issue around constant exchange rates is a tricky one, because if looking at a time series, the only way those really work is that if you continue to rebase to either exchange rate at the start or the end of it, let's say a 5-year period, and really if you don't do that, the only thing that works is the delta, is the percentage change. And so here we're focused on monetary amounts, and that's where it becomes difficult, I think, to get constant exchange rate metrics within this, because you can't build that type of time series unless we're demanding a 5-year record all adjusted to the end or start currency rate. On the issue around the definition of unusual and Tina's comments, I think there are a couple of things. Clearly, with it, as I said, within an NPM, you're free to put in or take out whatever you like. That may reflect our definition of unusual items. It may reflect something completely different. There is no interdependency or relationship necessarily between those two things. So you have complete freedom as a preparer over what goes into an NPM. I would say, if you do have material items, going back to the definition of materiality, and they can fit into the structure of your P&L, and Aida's about to talk about disaggregation, aggregation in a moment. If it's a material item, it can fit into your P&L structure, given the rules around by function, by nature. I think actually there's a requirement then to put that in there. As I say, we are looking at this issue of if you're reporting by function, you may need to disaggregate the functional line further to do that, rather than have a mixed measurement in terms of the line of the current proposals. So I think there is some scope there already, I hope.
Thank you, Nick. If we could just get the result of the poll on the screen before I just hand over to maybe Chiara to comment, because that is the response on the disclosure and reconciliation of management performance measures. And again, not a complete clear picture, but some directions. Chiara, do you have a reaction to that?
Yes, indeed. So I see the audience feel ready to jump into the future and go for including the reconciliations and disclosure for all the NPM used in the public communication. I think this will have a real impact if this is really consistent with the results of what we get at the end of our consultation, for sure. Yeah, I see it's still moving. The relevant majority, however, is
yeah. There seems to be some dynamics in the answer.
Yeah. Yeah.
Any short reaction by Nick, and followed by that, I think we'll move on directly to topic 4.
I guess very briefly, I mean, what we've heard from users is that these proposals are being very, very strongly welcomed. It's consistent with other studies that we've seen from users in the year before. We know from those studies what are the most common NPMs that they look at and value. So I think we'll continue to obviously listen to the feedback. I think it will be at this stage of the proposals a very significant move to open this up to a much wider set of NPMs, and will raise a lot of issues that would need some careful consideration.
Thank you. I'll now give the floor to Aida for topic 4. The questions we're not taking here online, EFRAG has promised that they will be looking at them afterwards. So I'll give the floor now to Aida for topic 4.
Thank you very much, Kristian. So what I will do is summarize the proposals on disaggregation that are on slide 29. But just to note, we actually already discussed several proposals for disaggregation. So proposed new structure with the subtotals and statement of performance are helping improve disaggregation, and also a proposal for unusual income and expenses that Nick has explained are also part of disaggregation improvements as a part of this project. But we have a few more proposals in here. Some are general proposals for principles, and some are more specific proposals that, in addition to unusual items, include additional required line items, specifically goodwill and items arising from the proposal for integral and non-integral associate and joint ventures, and then analysis of operating expenses by nature and by function. I will talk about that in just a little bit more detail. So I just want to briefly mention on the next slide, so the general proposals where we have proposed roles of primary financial statements and the notes, and the idea of this is to help preparers make their decisions as to what information is to be included in the primary financial statements and what information is to be disclosed in the notes. And then in addition, to help entities identify material information, we have developed a set of principles for aggregation and disaggregation to kind of help entities identify shared characteristics between items that will result in material disclosure. And just to highlight, whilst the project overall focuses on statement of financial performance and performance reporting, these proposals and principles for disaggregation would apply to the whole set of financial statements, so all primary financial statements as well as the notes. And then I mentioned in the introduction that users often commented about items labeled as other, that they don't find they have enough information about sometimes, so we have some specific proposals to help deal with that. So with that, I'm just going to jump to the next slide, which provides more detail about proposals relating to analysis of operating expenses. And the first is really, these are not new proposals, they are strengthening requirements that are already there in IS1. I think, David, you touched on that in your earlier discussion on the subtotals. And the proposals have really been driven, again, as everything else in this project, by demand from users who often give us examples of companies, for example, presenting gross profit, but then also presenting a separate line item for depreciation, for amortization, whereas other companies would present gross profit that would subsume related depreciation and amortization. And this made it very difficult for users to compare because they wouldn't know in this first example how much of this depreciation and amortization relates to should be in the cost of sales, should be part of that gross profit calculation. And this just made comparison very difficult because the information just was not complete. So the proposals are really around strengthening that to say that entities shall present either analysis by nature or by function, depending on which is more useful in their circumstances, in their industry, on the face. And then if entities provide this analysis by function, so in other words, if they present cost of sales, R&D, and so on, then they would be required to also analyze operating expenses by nature in the notes. And the reason for this is demand from users. And I think Nick mentioned earlier, in particular in Europe, to have this analysis by nature for all companies because it makes the link, it makes it easier for them to make a link between statement of financial performance and statement of cash flows, and it helps them better predict future cash flows. Whereas the function is more useful for things like margin analysis. So this is the proposal, and not to jump into what Chiara is going to say, but we have a fair amount of controversy about this in that I think some have asked as to whether the board should perhaps create some additional exceptions to when companies can present additional line items when they report by function, because currently the only exception to that is items that are labeled as minimum line items in IAS1, so things like credit impairment losses would be presented separately regardless of whether entity presents by function or by nature, but questions have been raised whether that should be expanded in order to achieve most useful information. We also have lots of feedback on the analysis of operating expenses by nature, perhaps being more costly for entities to apply. But I will stop here now.
Few words perhaps by my side to comment on topic one. We on the aggregation, disaggregation, we absolutely support the clarity of these added requirements. We think it will help to achieve more consistency. For the by function and by nature, as Aida was saying, the general principle seems to be that the entity has to choose whatever believes is more representative for their business, either by function or by nature. But there are already some exceptions, like, for example, the cost of sales or the impairment, which has to be a separate line item. So we suggest to clarify and spell out a little bit better what is the objective of having this choice between the function and the nature. Also in this case, we seek views to the citizens before taking a more close view, including whether a mixed presentation should continue to be allowed, as a little bit as Aida was already saying. And then we also question the usefulness of adding the disclosure breakdown by nature when an entity chooses to have a by function. I mean, if it's more representative of by function, why there should also be a by nature? And we are also interested in understanding the costs of producing these additional information.
Thank you. And I see we now have the result, at least for the polling, about whether it's important with the higher level of disaggregation, and there seems to be a overweight of at least important, fairly important, given from the audience. Now, we've had a very good debate today, and unfortunately that, of course, also takes a little bit of time, but we found it important to prioritize some of the other topics. So we have one topic left, but I don't think we'll have a debate on it. Rather, I'd ask Nick whether you can very briefly touch on the thoughts of topic 5 and then wrap up from the IASB side.
Of course, thank you. So this final slide on topic 5 is some limited changes to the statement of cash flows. and three main areas. First of all, to have a consistent starting point for the indirect method, and that would be operating profit. Again, this is something that users have asked for many years, to have a consistent starting point, and for that starting point to be a measure that's relatively high up the P&L, so that will be operating profit. There's a set of proposals in terms of how we deal with integral and non-integral associates and joint ventures, and the cash flows related to those. And then finally, I'm sure as many of you know, there's quite a degree of optionality around the treatment of interest paid and interest received, dividends paid and dividends received within our current requirements. And our proposals here are to eliminate that optionality. So they will always, those four lines, they'll be in different places, but they'll always be consistently in the same place. So dividends received, for instance, would always be in the investing category. And again, that provides a huge help to users to do that. I think there is more work to do on the cash flow statement. I know EFRAG are asking us for us to do more work on the cash flow statement. And as I mentioned earlier, I expect that to come up through the agenda consultation process. So just from my perspective, to wrap up, I really just wanted to thank everyone who's been actively participating in today's event, whether it's been on the screen or through the questions or through the polls. I think both Aida and I feel that we've had some fantastic feedback from the event, some real food for thought. To encourage others to continue to provide us with their insights and their comments, you will know that we have extended the comment period on our consultation document until the end of September here. So the further 3 months than the original comment period envisaged. But to continue feeding back to us, give us your comment letters. It's very important. Thank you.
Thank you, Nick. And Chiara?
Yes, perhaps also from me, a thank you note just to conclude. Thank you to the DI and FSR to organize with us and with the IASB this event. I'm sure that the feedback obtained today will offer very interesting feedback for our final comment letter. I just want to take the occasion to remind that until the end of July, we still welcome preparers to test the proposals in the field test. Thanks a lot for the fruitful participation.
Thank you, Chiara. And I think we actually also have the result of the final poll for today. Whether it's useful to start the statement of cash flows with the indirect method, with operating profit rather than the net profit. There seems to be a majority saying yes, and you can take that forward. And I also note the topic that EFRAG is saying that you would like to encourage a separate project on IAS 7. I can see a few questions coming in on that. So there's definitely more topics to be discussed. I think from my side and the Confederation of Danish Industry side, we would like to thank everyone for participating. And as I said earlier, the questions not taken now, EFRAG will look at them and hopefully we'll come back to them. I'll give the floor now to Jan Peter, who will formally close the event.
Thank you, Kristian. Thank you very much. The big work you have done in being very smooth. Discipline, not speaking. Here, that the head today really.
You're muted. I don't think they could hear you. Please try again.
Can you hear me now, Kristian? Okay.
There seems to be something wrong, at least from my side, when I listen to Jan Peter. So probably with the fear of overrunning it, I'll simply say also, I think Jan Peter was thanking everyone for today's event, and we'll definitely come back to you in the future. So with that short thing, thank you very much to everyone, both from our side, from the Danish Institute, and from the Danish society as such, and Prepare Society. So thank you very much to everyone, and have a nice day.
Thank you. Goodbye.
I don't know whether we are still live or whether we are.
I think we are still live.